Investors are awaiting the completion of the Federal Reserve's two-day policy meeting tomorrow, which could bring further stimulus or guidance on future interest rates. On the phone to discuss is David Morrison, market strategist from GFT. David, could you please begin by giving me an overview as to your interpretation of how the market is behaving in anticipation of the meeting's conclusion?
Well, markets are certainly in a bullish mood at the moment. There's a very good reason for this. We had the ECB's announcement last week of its outright monetary transactions, and once again, there's this feeling that central banks are sort of coming to the rescue and juicing up the markets and investor appetite for risk assets. And so, I think that's really where we are now. I think the fact that Ben Bernanke back when he made his Jackson Hole speech said that the job situation is a grave concern. So it's something that the Fed are looking at and focusing on, and of course the whole idea of maximum employment is the one part of the Fed's dual mandate.
So what are you expecting from the meeting?
Well, yeah, I think the market's feeling is very much now that there's going to be something significant. So, I think the sort of like the baseline, the sort of the very basics they're expecting is to extend the forward guidance from the end of 2014 further, maybe to the middle of 2015 and beyond. But I think what the market's pricing in here is something significant. We're talking and much more on the lines of the previous large-scale asset purchases that we've seen. So, something along the lines where the Fed is hosing in liquidity into the markets, and that's what we're getting priced in at the moment, and I think that's what the market is expecting. Whether they'll get that or not, I don't know. It's quite a big step for the Fed to make. If we look at sort of the situation that we're in at the moment, unlike when we had QE2, the 600 billion liquidity injection. Unlike then, we've now got U.S. equity markets anyway. It's close to 5-year highs. We've got bond yields close to record lows. The data out of the US has been mixed over the year, but hasn't been particularly good of late. PMI is not looking so good, but nevertheless, you've got US GDP is going to be looking like around 2%. Inflation again about 2%, and I guess then you've got to say that the Fed is really concentrating on the unemployment situation more than anything else.
Oil prices rose on Tuesday in choppy trading amid expectations that the Fed will act to bolster the economy, as you mentioned. How do you think oil will fare after the meeting, though?
Yeah, that's an interesting one. Oil has had a very nice rally. We had this big sell-off from March, and then a much sharper sell-off from May into June, and we've rallied very nicely since then. But if we look at the charts, we see that Brent it has run into resistance exactly where it's trading now, about 116.50, and for WTI we see a similar level of resistance around the 98 level, again where it is trading at the moment. Now, a lot of this move has been on the back of the expectation of further stimulus from the Fed on Thursday. So, I can't help thinking that perhaps oil has done enough for now that we're hitting resistance. If the FOMC delivers on Thursday, comes up with some extra stimulus, then we'll probably we should see a pop higher. But the question is that going to sort of carry on for much longer? The likelihood is we sort of struggle to push on much. Although of course we've still got geopolitical tensions, which are that geopolitical risk premium is certainly back in the oil price at the moment.
In terms of precious metals, gold received a boost as the dollar fell in light of a warning by credit rating agency Moody's that a downgrading may be on the cards. The metals investor sentiment was already bullish after last week's disappointing NFPs. Do you expect this trend to continue?
Yeah, I think there's been quite a swing in sentiment towards gold and silver as well. We saw both metals, and I suppose we should concentrate on gold, break out after a long period of consolidation in the summer, and to some extent that was driven by Mario Draghi's statement back at the end of July that he was prepared to do whatever it takes to save the euro. But I think there was also a lot of pent-up, frustrated buyers waiting for something to happen in the gold market. And I think the underlying fundamentals for gold and silver are very positive. However, I do think that both of them have rallied a very long way in a very short space of time. Obviously, this has meant that we've got an awful lot of frustrated would-be buyers out there who have been looking for some kind of pullback in order to get involved in the gold market, and so far have been frustrated. But I thought, we saw a very, very sharp reaction from gold after the non-farms data, because it was a terrible number, and I think investors are piling in and saying, right, QE3 rather is now, it's now baked in the cake. So, if the FOMC does disappoint on Thursday, then I think that gold could come back very sharply.
You mentioned baked in the cake. Do you think the market reaction will be dampened, given that to some extent monetary policy has already been priced in?
So I would have said that there's a big scope for disappointment here. I know a lot of people are saying, well, look, that this is the Fed's last chance now to act before the presidential election, and I know other people say, well, actually, that the Fed's last chance to act before the presidential election has been and gone. And by what I mean by that is, as we get, within a couple of months of the presidential election, anything that the Fed does now is going to be quite controversial, and it'll raise the arguments between the Democrats and the Republicans over what the Fed should be doing, how successful their measures have been so far, and the Republicans would argue that they have been, and not just the Republicans, a lot of people would argue that actually the stimulus measures that they've undertaken so far have been anything but successful. So I think what we might see, though, is that maybe the Fed doesn't come up with the goods on Thursday, but it's going to be promising. It's going to be saying that we will stand ready to act in the future. So I think the initial reaction, if the Fed doesn't deliver, will be disappointment. I think we'll see a big sell-off in risks. So that's equities, that's gold, possibly quite a bit in oil as well. But I think the promise of further action down the line will keep some support in the markets, and it'll just keep that sort of feeling that we will be getting stimulus somewhere down the line, because after all, that's really what that's been the central bank's only response to the financial crisis so far.
David, thank you very much for joining me today. Well, that's all we've got time for at the moment, but please do click that Dukascopy for updates and analysis throughout the day. Bye for now.